this is just the way the world is going. We are migrating to an on-chain world. I mean, NASDAQ, right, is seeking approval from the SEC and looking to what does a world look like at 24/7, 365 trading, where all assets can be traded on chain if their clients want to. And so in firms like ours, large asset managers, we're seeing the banks, our own government, right? So I think our view is that this is just where things are headed. And so now, if you believe in that world, it really does become an interesting question of what things need to change to accommodate that kind of evolution of our financial system.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities, and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, battery materials, and precious metals markets. Smarter markets are here.
Welcome back to Reengineering Tokenization on Smarter Markets. I'm Dave Greely, Chief Economist at Abax Technologies. Our guest today is Christopher Jensen, Portfolio Manager and Director of Digital Asset Research at Franklin Templeton. We'll be discussing his experience tokenizing money market shares with their BENJI token and the challenges and opportunities that he sees for both the builders and the investors in tokenization for real-world and digitally native assets. Hello, Christopher. Welcome to Smarter Markets.
Hi there. Pleasure to be here.
Well, it's a pleasure to have you here, and it's a good timing for the conversation. I know recently in the news, Franklin Templeton announced that you plugged your BENJI token, which is a digital share of a money market fund, into the Canton network to allow for broader access to institutional investors. So always a good time to talk about tokenization efforts. I was wondering if you could tell us a little bit about the BENJI token, what it is, and why was it developed?
Sure. And again, thanks for the opportunity. We're pretty excited about it. So BENJI is what we refer to as both our tokenization platform and really in this effort of bringing real world assets and deploying them on chain, onto different blockchains in their ecosystems. We started with one of our own funds. So we started with a money market fund, and it's a fund that exists and has existed well before blockchains. But what we did there was tokenize the share class, as you mentioned, and we're representing the ownership in that fund on several different blockchains. So Canton being one of our latest deployments. And so when you, as a shareholder, own a BENJI token, you are owning a piece of that fund, and that record of ownership exists fully on chain. So no duplicate books and records off chain. The source of truth resides on the blockchain. And so with that, it's pretty powerful. You're now moving at blockchain speed and can do things with those assets when they are on chain.
And is it a challenge to make the blockchain itself the single source of truth? I know some have ledgers that they keep in addition to the blockchain. How do you think about that?
It's interesting when we think about these various tokenization initiatives, it really involves three kind of pillars of success. One is there's a technology piece. How do you actually do this? And that's becoming more straightforward these days. The second piece is not technologically how do you do it, but how do you do it from a regulatory compliance standpoint? So it should be noted, BENJI is a security token. So this is different from, say, a stable coin, which is truly kind of permissionless and low friction, can really travel anywhere. When it comes to a security token, you need to know who's on the other side of the transaction. So, know your customer, AML, these are still valid in the on-chain world, just like they are in the off-chain world. So the second piece was, how do you do this all from a regulatory compliant framework? And then the third piece is, just because you tokenize an asset and you bring it on chain, doesn't by itself entail liquidity. So how do you get the flywheel going, so to speak, and whether that's through integrations or partnerships, but create some of that demand side now that you've added new supply in the form of a new product on chain.
And could you walk us through a little bit more some of those regulatory challenges? Because as you said, money market funds or securities, and there's a lot of regulation that's built up around that. How do you bring that or meet those regulatory needs in the blockchain space?
Excellent question. And it definitely relates back to the ease or difficulty of running books and records on chain or both on and off chain and getting regulatory approval to really just have one source of truth and have that be represented on chain. So, I mean, the short answer was it was a very long process and an iterative process with the SEC. So, I think all in, it was probably over 70 meetings across years to kind of get to the finish line on this. So a project we actually, quite frankly, started back when rates were near zero, and then by the time got those approvals and it came out, we were in a very different rate environment, and so there's definitely been some product market fit for something like a tokenized money market fund. So I would say it was an iterative process. It's an educational process. So much of this is educating the regulators, working with the regulators and different parts of the ecosystem to understand exactly what this technology can unlock, how it works, but also, what kind of risk mitigating factors might need to be put in place as well. So now that we have something like the Genius Act, which provides a regulated federal framework for how we think about stable coins, it's legislation like that, which I think can help provide clarity on this industry. That's obviously just related to stable coins, but it's the first of what I think more to come. So as we get these additional pieces of clarity, of regulatory clarity, hopefully that leads to even more innovation in the institutional tokenized product space.
And I wanted to ask you about the comparison and contrast between what you're doing with Benji and stable coins, especially as you said, an important part of we've moved into a higher rate environment. And one of the issues on stable coins has been who gets the interest. How does that work for a Benji token? And how do you see their role relative to, say, a stable coin?
Yeah, definitely. One mental model is almost like stable coins are a little bit more like your very low interest checking account. And it's more your fungible cash that can be used for payments in a very low friction way and really much more used and thought of as a payment mechanism and not really as a savings instrument or a yield bearing instrument. And so that's one way I think of the differentiation. Stable coins can have very high velocity, whereas money that's kind of earmarked for cash and cash equivalents that is a little bit more stationary in nature can be parked in a savings account or in a money market fund, or in this case, a tokenized money market fund. And with that, all the yield that's generated by the collateral that backs it, in this case, treasuries, really all goes to the customer. So they can realize pretty high interest rate without much leakage from holding one of these. It can actually be used as a payment, coin. The one kind of caveat there is if I were to send you a Benji token, right, I would just need to know who's on the other side of the trade because it is a security token. But it can be transferred. And another nice thing that the blockchain enables is that if we transfer it midday, you start accruing interest the very next minute. So, in the traditional system, I'd have to wait to the next day. Here, you could actually move large sums of money around and you get that interest accrual the very next second after it transfers, and you have kind of instant settlement on that transfer. So definitely has some unique properties with respect to moving money, but then its ability to be a yield bearing instrument along the journey of that movement. And when it resides in your own account is definitely a beneficial feature as well.
And you've mentioned a couple times needing to know who's on the other side of the trade because it is a security. How is that handled with Benji?
The way we kind of onboard and do that check, the KYC AML component of this. For retail, we have kind of like a fintech, more web 2.0 type of onboarding platform that takes in a customer. It's actually pretty easy to do. You can do it in under a minute, I think. Then it could be as low as $20. So, very low kind of barriers to entry, low friction, but it does kind of let us know who you are. And that's important because if you were to transfer it to me or vice versa, we would need, the system would need to kind of know each other. For institutions, they can come in through kind of more of a website portal. They don't need kind of a mobile app. So a couple different ways to come in, but that AML KYC piece is done by Franklin Templeton. And that's what enables us to know that if transfers are happening, it is between kind of known counterparties.
And you mentioned that you put Benji on a number of different chains. Canton's the most recent. How do you think about the various features of those chains and maybe which market segment you're trying to reach through them?
Yeah, excellent question. And this really gets into kind of relating it back to my comment about the three pillars of success when it comes to tokenization. So that third pillar, how do you get the flywheel going for these new products, the demand side? So much of that is really tapping into the vibrancy of that blockchain's kind of unique ecosystem, and whether you're integrating with certain kind of partners there or opening up additional utility for things that you can do with this asset now that it is on that chain, all that lends itself to greater kind of usefulness beyond just the yield that you're generating. So when we think about different blockchain ecosystems, I mean, first and foremost, we want to make sure they're credible. We have a whole suitability kind of framework that was developed in conjunction with the BENJI side of our house, which again is building and deploying products on chain, and the investment side of the house, which is actually doing diligence on these various chains and applications and teams building on these chains and thinking about which ones would make good investments for a portfolio. So it's very synergistic between these two sides of our digital assets platform. And through that kind of back and forth, there's a view on a certain chain. And so we want to see certain kind of operational soundness. We want to see a certain amount of economic activity, users, developers, assets there, such that we have some belief that when we deploy there, there's actually people who can use it. There's a use case for it and that sort of thing. So different blockchain ecosystems definitely have their different culture, their different technological edge, and so on and so forth. And some are permissionless, some are permissioned. And so it's really kind of figuring out what does each ecosystem kind of bring to the table and what can we bring to the table as we deploy Benji there or other products.
And how do you think about if a user might be on multiple chains? Can they move the token across them, or do you have separate kind of pools that you can operate in?
So we can certainly help facilitate that. It's to bridge interoperability, obviously, between these blockchain ecosystems is still very much something that is evolving, right? And so to go kind of crypto natively transfer from one ecosystem to another, depending on those ecosystems, that can be challenging for non-security tokens and even more challenging for security tokens. We can help facilitate that bridge. So there's definitely clients who, and a lot of times the actual blockchain is abstracted away. So a lot of times a user of Benji will just be using it and earning with it or transferring it and not even knowing what blockchain is facilitating it on the back end. But if they were aware and they wanted to transfer, that is something that we can help facilitate it as well, just to make sure it's safe and secure.
I want to move on to talking about some of your broader efforts in real world assets. But before we do, I just want to ask for all real world assets, there's always like, how do you maintain the bridge between the token on the chain and the actual asset? And whether transfer agents or custodians or whoever are involved, how do you think about that piece of tying what's on the chain to the ownership in the real world?
Yeah. So in that sense, it's actually easier for us with only one set of books and records. So there's only one source of truth, at least for the ownership of these coins. That set of records is on chain. So it is the canonical source of truth. There's no reconciliation between an off chain set of books and records. So that's the ownership. And then if a lot of users are coming and buying Benji, that obviously gets collateralized on the back end with real world treasuries and whatnot. But the portfolio manager or team of the fund is the same, and they're the ones actually doing the portfolio management, buying and selling and rolling the treasuries and maintaining the collateral pool.
I wanted to kind of open up the lens here because you said something very interesting that when you think about your tokenization efforts at Franklin Templeton, you think of yourselves as builders and investors. So I wanted to kind of ask you, like, could you expand on that a little bit? And what's your overall tokenization strategy in those two halves?
We started going down this rabbit hole in 2018 and 19 as a firm. And we sensed there was really something to this technology, that it wasn't a fad that it had the power to transform industries, our own industry, asset management and the wealth industry being one of those. And so it really started off as an exploration of what is this technology and what can it do? That kind of exploration really revealed one of its key value propositions. When you think about it, blockchains decrease the cost of trust. You can have any system and when it's on chain, you can take out the amount of intermediaries needed to operate that system, that network. And so there's an inherent cost savings value proposition to crypto. And that's what we certainly realize for ourselves first. But then what we realize is the composability of blockchains also allow you to build and do things that you just couldn't do before. So it's not just cost savings, but you can actually do things that you couldn't do before. And with BENJI, the great example there is it's just physically impossible to have something trade 24/7, 365 and pick up yield intraday. And, but when you have the tokenized asset on chain, you can actually do that. And so it started with first realizing what we could do with the technology. But then we started to also realize, hey, these digital asset tokens, there's a possibility this could evolve into its own legitimate asset class. But it's not all that often that a new asset class emerges. And Franklin Templeton, as a global asset manager across asset classes, certainly something like this, even if it was just a possibility, needed to be on the radar. And so we started figuring out, what are these tokens? Are they more equity-like or bond-like, commodity-like? And actually, they can have properties of all three. But how do you value them? How do they actually accrue value? How do you quantify that? If you were to invest in it, like, where might it go in a portfolio? How would you allocate or fund that position? How large should that position be? So there's an entire kind of investment piece that we feel like that goes along with digital assets and blockchain technology. And so that's really the investment side of our house. What is this new asset class? How do you value it? Where should it go? And what are the different types of ways to access it? We have crypto ETFs. There's early stage blockchain venture. You can invest or pick a manager to go invest in liquid tokens for you. There's market neutral strategies. And so a lot of times investors are having questions about how to navigate that space, in addition to, hey, what might this industry do with this technology? So we play in both spheres.
And when you talk about the investment side and thinking of it as a new asset class, is that for digitally native tokens or for real world as well?
It's more for digitally native tokens because I think when the real world asset is represented on chain, if you were to value it, it's still valuing the real world asset. I think now we're starting to see some kind of crossover enterprises like Coinbase as a public stock. Valuing that public equity is interesting because those equity analysts who cover Coinbase have to also think about what is the value of their Coinbase's layer two blockchain or the app there. I mean, the app's generating real world fees, but what kind of value do you put on Base as a layer two blockchain? And so, that when you're doing some of the parts there, you are actually doing crypto native valuation plus off chain corporate valuation as well.
I think it's interesting. You've done the exploration for yourselves. You're also helping people with the investment advice and investment strategy. Maybe could you tell us what's your most common piece of advice on the investment side? Because there's so many different tokens, so many different ways of doing it. Is there a way to cut through a lot of that noise? Do you have certain principles or something for how to scope these things out?
Yeah, when you do lots of different types of back testing and portfolio modeling under different regimes, I think the one is assuming you have the right, risk appetite and time horizon. The most important thing, and also the easiest thing, is to get off zero, as they say. And usually it starts with dipping a toe. And depending on the individual or the institution, that could be 1%, that could be 5%. It's really specific to obviously the client. But the first way to get engaged is usually through Bitcoin. Bitcoin is still king after all these years. It still represents about 60% of the total crypto market cap. The one little asterisk there is that Bitcoin, we really look at it more as this macro financial asset. The digital gold mental model, I think, is a good one. Whereas everything else, I look at it a little bit more as a technology asset where I'm worried about, defensibility and holding on to users and the economic activity generated on that chain or with that application and revenues and how does that value get back to the token. So it's much more nuanced in the everything other than Bitcoin world. I think when looking at Bitcoin, it was a little different because it's used and it's valued and it's thought of a little bit differently. But that's certainly the easiest way to get started because, again, it's about 60% of the total market. It comes in ETF form, it comes in spot form, there's futures for, I mean, so there's a lot of liquidity. That's the easiest place to get started.
When you talk about it that way in my commodities brain, it makes me think of like you have the benchmark and then you have all the basis and the spreads relative to the benchmark with the other chains. When you think about valuing, and you said the technology aspect of other chains, is a lot of it about the market segment it reaches? Is it about the network that it lets you tap into? Or maybe you could just kind of say what it is instead of me guessing.
Yeah, a little bit. And I think another way to think about your question is certainly from a venture standpoint, right? If a certain application or blockchain is going after a very large market, so we would say, right, is total addressable market, is TAM is quite large. It has the potential to be more valuable if it can execute on that growth strategy and make inroads into that market. But some of these applications or use cases are much more narrow. So they might be the clear market leader, but the overall value of that pie might not be as great as some of these other end markets. So everything there is very akin to what we do in looking at equities or whatnot. So my background is in investing kind of across alternative asset classes and usually areas of esoteric or kind of complexity at this intersection of technology and finance. So, kind of bridging that over to crypto, very kind of natural extension of pushing the envelope with technology and finance. It definitely is new and nuanced and complex at times, but it's very much the same questions you'd ask in the on-chain world as we would as investors ask in the off-chain world. What does the business do if we were to look at it as a business? Why does it need to exist? Is it delivering a product, good or service that someone values enough they'd be willing to pay for it? Where does that money go? And how does that get back to the token price going up for fundamental reasons rather than just, speculative or narrative driven reasons?
And I wanted to pivot back to the builder side of your approach. You said you'd done a deep exploration of how this new technology could be brought in, how it could help build trust, how it could help remove some of the layers of intermediation and the frictions in the existing financial infrastructure. I'm curious when you think about when you were doing that exploration and thinking of being a builder, what did you see needed to be built in the beginning in order to bring this more into the traditional finance system or to the traditional financial investor?
It's interesting because a lot of times with new technologies, people tend to think just outside the box. But when the whole box moves, that's when you get really kind of creative new use cases. And so I think initially it was what something that we know exists off chain look like on chain, right? So it wasn't asking as creative questions as now I think our view is, hey, this is just the way the world is going. We are migrating to an on-chain world. I mean, NASDAQ, right, is seeking approval from the SEC and looking to what does a world look like at 24/7, 365 trading where all assets can be traded on chain if their clients want to. And so in firms like ours, large asset managers, we're seeing the banks, our own government, right? So I think our view is that this is just where things are headed. And so now, if you believe in that world, it really does become an interesting question of what things need to change to accommodate that kind of evolution of our financial system. So, for instance, for the asset management industry, for the wealth management industry, the way we think about advising clients or managing between different accounts, if we're moving to a world where all your assets, your traditional assets, your crypto native assets, and maybe it's things that you collect and cultural assets, all these different types of assets are just represented in your digital wallet. And that's something you can custody on your own, or you get help in custody in that, but it's something that you own and you get to bring with you. And if I were to do now wealth management for a client like that, what does that look like when I think about portfolio rebalancing across different types of assets? So I think there's so many interesting areas for innovation as we think about the kind of where we're headed, right? And that's just in finance. And then you see the same exercise happen in other industries too.
And for large asset managers like your own, it sounds almost like you could see basically the back office migrating on chain. Is that fair?
Yeah, and that certainly fits into the first part of the value proposition, which is cost savings. But then on the other prong, you can do new things. I think the capital efficiency of assets. If I just had everything in one wallet and I could be borrowing against certain assets, and maybe that's being deployed into a yield strategy. And actually, what I'm borrowing against is something that I never wanted to move anyway. Like it's something I collect, but it's in tokenized form. I'm just making that otherwise stationary idle asset more capital efficient. And so being able to do more with my portfolio in these assets when they're on blockchain rails. So there's cost savings, but then you get actually added utility.
I'd love to dig into that a little bit more from the user experience end, right? Because I think we're all familiar. You've got your bank account and you log into your bank and you can transfer money around. You can get, if you have an account at Franklin Templeton or a brokerage, you can go in and everything's very separate, different logins. You're having to move assets, wait a couple days. How would that experience be different in more of an on-chain future where I guess the banks, the asset managers, your wealth advisor are all handling these assets differently and not on the traditional back office ledgers?
So, for example, one way these worlds could be integrated, and which actually they are. This isn't just thought experiments, but crypto native assets that sit in your wallet could be a source of a collateral that you borrow with in the real world. So you could have a debit card or a credit card actually, be used to facilitate real world transactions, and that lending capacity is actually extended based on the individual's assets which reside on chain, and so that's very known. The blockchain is very transparent about this, and so you could actually extend credit based on on-chain assets and use that credit in the real world to buy off-chain goods and services, which is pretty wild that you can get this kind of melding of the two.
And what do you see as some of the biggest challenges kind of moving from the world we're in now to the world we could be? Is it the regulatory piece, a technology piece? Where do you see the obstacles?
Regulatory for sure. So Genius Act, great first step. Market is definitely waiting on Clarity Act, market structure bill, and others. But I think that will come, that will help tax guidance. And we're starting to see some things come out, but with respect to staking and other kind of more crypto native activities, how should they be thought of from a tax perspective? So these are key pieces of the puzzle that obviously need to be ironed out. But what gives us encouragement is we see progress on all these fronts. And so whether it's institutions or regulators or everybody does seem to have this kind of common vision and be kind of rowing in the same direction, so to speak, which is definitely a healthy change from, I think, just a couple of years ago.
And when you think about the different market segments, I know crypto's traditionally been seen a little bit more at the retail level or the individual level, and now it's moving to the banks, to the large financial institutions, the big asset managers. How do you think about the needs for it to be acceptable to more institutional users as opposed to the retail level?
I mean, obviously, both parts of the market are critical here. We are seeing institutions get more involved. Their process conversion timeline just takes longer, but they are critical. We saw them first show up with the ETFs, and obviously the kind of the crypto ETPs here in the States, some of the most successful ETPs to date. And then from there, it's almost like what we were talking about, dipping the toe. Right from there, they're wondering, what else can I do? How else can I think about my exposure? So they are getting involved, and we're seeing more and more enterprises think about either deploying a stable coin or building some infrastructure or getting involved that way. Another big institutional movement was the digital asset treasury company phenomena, kind of pioneered by Michael Saylor and MicroStrategy, but seeing kind of institutions who buy these digital assets and not just buy it, but then can kind of use DeFi or use some of the technology on the back end to improve operations rather than just kind of buy and hold the asset on their balance sheet. So I think this institutionalization is taking different flavors and also depending on where you are in the world. So we're seeing a lot of build out in places like the Middle East, Southeast Asia, here in the United States as well.
And I wanted to thank you for spending time with us today. It's a great conversation. Before you go, kind of circling back to where we started with the money market funds and real world assets, how do you think about some of the opportunities over the next few years in that space? And how does that compare to the opportunities more on the pure digitally native side?
That really relates to another question, which I get a lot is, okay, you've done this with a money market fund. Franklin has a lot of funds. Which fund is next? And I think where we've spent a lot of our time to date is really doing as much as we can with BENJI, because this, again, going back to our three pillars, this really clears the path, both from a technology standpoint and a regulatory standpoint, that then you can move all different kinds of institutional grade investment products through, right? Once you do it with one, you've set precedent, you paved the way. Thank you so much for the question, because it does connect to a lot of things we've been saying. With BENJI, we've tried to improve its utility. Initially, you couldn't do transfers. The intraday yield concept didn't exist. It wasn't being used as collateral on exchanges. So we've really enhanced the utility of it. We've moved it to different blockchain ecosystems. And you mentioned Canton being the most recent. We're now on double digit now number of different blockchains and their ecosystems. And then we've also expanded geographically as well. So there's versions of BENJI in other parts of the world that meet those local regulations. And so once you have this framework, you can imagine now doing it with other investment products, with other asset classes. And so I think we're really, as an industry, just scratching the surface here. So I think there'll always be great demand and innovation happening on the crypto native side, but we're really just getting started with the world's kind of traditional assets moving on chain. And that's why we think, even though the industry's been around a while, right now is such an interesting inflection point, because it really represents these two worlds converging. And what's allowing that is regulation, is the institutions coming in, especially those who are taking that kind of first mover to figure things out and be the first ones to deploy some of their own products on chain. So we're excited to see more of that as we go into 2026.
Thanks again to Christopher Jensen, Portfolio Manager and Director of Digital Asset Research at Franklin Templeton. We hope you enjoyed the episode. We'll be back next week with another episode of Reengineering Tokenization. We hope you'll join us.
This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, battery materials, and precious metals markets. Smarter Markets are here. Contact sales at abax.exchange to get started. That concludes this week's episode of Smarter Markets by Abax. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abax Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.